Hi everyone, welcome to BISP Trainings. My name is Faiza Alam. In this session, we'll be having an overview or an introduction to the revenue recognition. So let's begin. First, we should know what is revenue. So revenue is the money that a company earns from the sale of goods and services to its customer. It is one of the core element for the financial statements, and it is used to invest in other assets, paying off the liabilities and paying off the dividends to shareholders. Its common examples can be sales, dividend revenue, interest revenue, etc. And revenue can be deferred or it can be accrued also. So if we talk about revenue recognition, so revenue recognition is an accounting principle which states that revenue must be recognized as it is earned, not when the cash is received. We can take an example here. There can be scenarios in which goods and services have been provided, but we are not having the receipt of the cash. So that will be means we can say that we can recognize the revenue as we have provided services and goods, but we have not received cash. So it has nothing to do with the receiving of the cash. Only it is concerned with how and when we have provided services. At that time, we can recognize the revenue. It is a key component of accrual basis of accounting, and revenue is generally recognized after the product is being delivered to the customer. So the FASB, that is Financial Accounting Standard Board, has been collaborated with IASB, that is International Accounting Standard Board, and issued the IFRS15 guidelines for the revenue from contract with customer in order to recognize the revenue recognition approach and provide related standards to it. So, as mentioned earlier, that FASB, that is Financial Accounting Standard Board, has collaborated with IASB, and the FASB created the AAC, that is Accounting Standard Codification 606, and it is about recognition of revenue from contracts with customer that impacts US based companies only. So this AAC 606 is the new revenue recognition standard that affects all the business that enter into contract with customer to transfer goods or services, whether it is a public, private or non-profit entities. So this is about AAC 606. So if we take IASB, that has created the IFRS 15, that is International Financial Reporting Standard. So the same rules will be there as of AAC 606 for IFRS, and to unify these standards across the globe. So these are the two basic accounting standards that are followed for recognizing revenue. In order to recognize revenue under IFRS 15, a five-step model should be followed over there. So it has certain steps in it. So the first step for recognizing revenue is identify the contract with customer, which means that there must be a contract between a company and a customer, and that contract can be written or oral, or it can be implied. So there must be some agreement between a company and a customer, that in which both parties agree to the contract. They can identify the payment terms and the given rights mentioned over there. So there must be a contract. That this is the basic or the first requisite for recognizing revenue. Then comes the performance obligation. A contract can have a single performance obligation, or it can have multiple performance obligations. So what is a performance obligation? It is a promise that is made to the customer for delivering or for the transfer of products or services, and company must provide a distinct product or service. We can take an example here. If an equipment is to be sold out, so this is the first performance obligation. Its sale has been done. So we can say that it has a single performance obligation. But if that equipment requires certain installations and certain trainings and all, so it can have, we can say that now the contract has three performance obligations in it. So there can be a single performance obligation or it can have multiple performance obligations. So we have to make the identification of that. Then comes the transaction price. We have to determine the transaction price. This is the next step in the recognition of revenue. So what is the transaction price? It is the amount that an entity expects to be entitled in exchange for the transfer of goods and services. And we can say that for the determination of transaction price, we have to determine how much are we going to record for the revenue. Means what is the consideration that we will be receiving in future, and that consideration, that transaction price can be fixed or it can be variable. Suppose we purchase a mobile phone and we pay for it some 5,000. So there we can say that its price is fixed, but it can be variable. Means based on the consideration, there can be scenarios in which the customer make payment on time, or he'll be paying it in 10 days later, or he'll be paying it 20 days later. So based on the probability, the prices or the transaction price can be variable. So we have to determine that price, whether it is fixed or variable, and how much are we going to receive from the customer. That is about the determination of transaction price. Next comes the allocation of the transaction price to a separate performance obligation. Like just as mentioned earlier, that if we sold out any equipment, and so this is one performance obligation. But if too many performance obligations are involved in that, so how can we allocate that price? So if the contract has multiple performance obligation, you can see an equipment transaction price is 4 lakh. Its installation price is 15,000, and if it has training, so it has 20,000. So this is the transaction price. Then comes the standalone selling price. So what is that? It is the price at which the entity will sell a promised goods or services individually to a customer. So the standalone selling price for an equipment is 4,50,000. Its installation is 20, and its training is 25,000. And all in all, it is coming to 4,95,000. So what happens? We have to allocate this price. We are not taking this installation and training. That means these are the future events. So we'll take this 4,50,000, and we have to distribute it or allocate it over all these performance obligations. So how we will do that? So first we have to m- calculate a proportion for it. So for that, we'll divide 4,50,000 to 4,95,000. That comes to 90.90. Then we'll divide 20,000 to 4,95,000. That comes to 4.05%. And then we'll divide 25,000 to 4,95,000. That comes to 5.05. So this is the proportion that we have, and we will divide that 4,50,000 into this proportion. So when we divide this 4,50,000 into 90.90, so we can allocate the price into this amount. Then after for installation, if we divide 4,50,000 for this proportion, that is 4.05, so we'll arrive at it. Then we'll divide 4,50,000 into 5.05, so we can have the training amount as 22725. And in this manner, we can allocate this 4,50,000 over all these performance obligation. So this is the way how can we allocate the prices if the contract has more than one performance obligation. And the last step for the purpose of recognizing revenue, when all the performance obligations are satisfied, we can recognize revenue at that time. And the performance obligations can be satisfied. We can recognize revenue over a time or a point in time. There can be a time frame for it. We can recognize it over a period of time, or with either in a point in time. So what happens when we satisfy the performance obligation, when we finally transfer the goods and services to the customer? So we can say that at that time we can recognize revenue. So these are the 5 steps that are followed for the purpose of revenue recognition. And these are the guidelines that are given by the IFRS 15 for recognizing revenue for any contract with customer. Moving on to the NetSuite Revenue Recognition. So NetSuite Revenue Management simplifies the process for recognizing revenue by eliminating use of spreadsheets and manual data entry. Like here we can user can create specific recognition rules for each product and services, and they offer and easily link them to the specific line items in a customer contract. Along with that, this feature enables us to recognize revenue independently from billing customer and receiving payments to defer revenue for recognition in multiple time periods. All in all, it is a rule-based event handling framework which tracks the transaction of sale of goods and services or both. Along with that, this a revenue recognition feature is a prerequisite for revenue commitments. It has VSOE, then various other guidelines given by the FASB and IASB. There are certain important consideration that we have to work on while recognizing the revenue in the NetSuite application. First, we'll look into the revenue arrangements. Then, how can we configure the item records with the given revenue arrangement? What are the revenue elements? What are the revenue recognition rules? And what are the revenue recognition plans? So, these are the various features that are involved in the NetSuite revenue recognition that we'll be looking in our upcoming session. So, today we have seen what is the basic concept of revenue recognition. How can we recognize by following the 5 step model, and we have also seen what is there in our NetSuite revenue recognition concept. So in our upcoming session we'll look into each feature in a detailed manner. So that's all about the topic. In case of any doubts and consultations, you can reach out to us at www.bispsolutions.com. Thank you.